Okay, so our lesson is going to be on limited liability companies and the accounting of corporations, as they are called, companies. So the limited liability companies, in your workbooks, CIC workbooks, you go to page 129 and you will get all of the information that was put there for you. Limited liability company. It is a type of business organization created under the Companies Act whose capital is divided into units called shares and whose owners are legally liable for company debts only to the extent of the amount of capital they invested. So limited liability companies are also known as corporations, hence the heading Accounting for Corporations. So what we said is that we have our shareholders. The shareholders become the owners by investing capital, by buying shares. That is how they make an investment. So when they buy the shares, they become the owners of the business. And the reason why it is called a limited liability company is we know that with the sole trader and the partnership, they had unlimited liability, which means that they were at risk of losing their personal assets as well as their investment. With the limited liability company, what it means is that the liability is limited only to their business assets, or in other words, how much they invested in the business. So they are not at risk of losing their personal assets, only the company business investments, right? So we have for the limited liability companies, we have a private limited company and we have the public limited company. And the public limited company is the one that anybody can go on a stock exchange and purchase shares and become shareholders. So once again, the private limited company, basically the main thing about it, it would be that it is family members especially, and probably some friends, 2 to 50 shareholders with, of course, permission. So you cannot just go and buy shares. They cannot just sell their shares. You have to get permission from the CEO. Whereas the public limited company, 2 to a maximum amount, you're going to state legally how many shares you can sell or you are willing to sell. So that is called your authorized share capital. You will see terms like that popping up as we do the accounting. So public limited, easily transferable in terms of the shares and therefore in terms of ownership. Ownership is easily transferable. As I said, you just go on the stock exchange and you can buy shares. They sell shares for the public limited company on the stock exchange. Anybody, including superheroes and stuff, right? So methods of raising capital. There are 2 methods. Basically, it will be the equity, and that is where you issue the shares, and those that buy shares in a corporation become shareholders, which are the owners of the business. And then there is, of course, debt capital. This is where you borrow. So you borrow from a financial institution like a bank. And in this case, this is something new that we are introducing. They issue what is called debentures. Debenture holders, or the people that purchase debentures from the corporation, become creditors or payables, meaning that the business owes them. So if they issue shares, the shareholders are the owners. If they issue debentures, the debenture holders are creditors, people that the business, the corporation, owes money to. So what we are going to go into now would be what we call shareholders equity. Shareholders equity shows how much the owners or the shareholders of a company have invested in the business, either by investing money in terms of share capital or by retaining earnings over time. So we will go more into what retained earnings are. Basically, retained earnings is whenever you make a profit and you keep that money in the business to use for the continued future operation of the business. Okay, so you make a profit, and instead of just giving it out to the owners in the form of what we call dividends, we keep it in the business to continue to develop that business and let it grow. So shareholders' equity is comprised of the share capital, which is ordinary and preference, which we're going to go into in terms of type of shares, and the reserves, which is capital and revenue reserve. We will go into when we're doing the balance sheet or the statement of financial position. We have what is called authorized share capital, which is the maximum amount of shares that a company can issue. It is legally what is stated as the amount of shares that they're going to issue. You should have learned this like in POB, so we're not going to go into much details, but they have the definitions for you anyway. The issued share capital is the actual amount of shares issued. Issued simply means sold. So remember, we were talking about the stock exchange and selling shares. Issued is what we call selling of shares. Issued. And the share premium, we're going to go into that when you're doing the accounting. Yes, we will leave that to explain it. It will become clear. But these are the three things that constitute the capital part of it, the share capital. So you have the authorized, which is just how much you can sell. You have the issued, which is how much you actually did sell. And then there's a share premium, which we will get into in a while. And then you, of course, have your general reserves. And then there is the retained earnings, which is the profits that you keep in the business. Okay, so you don't give it out, as we said before. All of those things we will go into in more detail as we move on to the accounting and the different aspects of the accounting for the corporation or limited liability. So what we will do is we will end this lesson, but in another video, I will do the issuing of shares. Remember what issue is. It is selling the shares. That is how we get the share capital. Those that buy it become the shareholders, which are the owners. They receive a dividend. So these things are going to keep on coming up. That's it for today's lesson.